Okay, let's do another update. It's Friday, August 30th at about 11 a.m. We'll start with NVIDIA. So we survived NVIDIA's earnings this week. NVIDIA reported on Wednesday, and my expectation was that they would probably beat expectations. And I thought that, given that there were phantom ticks higher in NVIDIA, that earnings would be used as an excuse for the stock to run higher and hit those phantom ticks. But their results were only slightly better than expectations, and their forecasts for next quarter were again only slightly better than what analysts were forecasting for next quarter. So it's apparent that their growth is decelerating, and the market tends not to like decelerating growth. So NVIDIA sold off. Now, does that mean it's the end for NVIDIA? It's unclear. It wouldn't surprise me. The market's done sillier things if NVIDIA were to run higher from here. But then again, as growth is decelerating and as there are other headwinds for equities at the moment, which I'll get into a little bit later, we could see NVIDIA continue to drift lower. Now, I think let me show this chart here, is their growth. This is their quarterly revenue on a year-over-year basis. So they had $30 billion in earnings in Q2. That was 122% greater than its Q2 revenues from last year. Their projected revenues for Q3 will be 79% higher than their Q3 revenues of last year if they hit those projections. And so, as you can see, growth is decelerating, and their stock has essentially been drifting lower since it hit its all-time high a few months ago. Now, one thing that was pointed out by analysts is that on the conference call, the CEO was asked whether or not any of NVIDIA's customers had any apps that were able to generate revenue. Were they monetizing AI? And instead of answering that question, he dodged that question. And so the big concern in the analyst community and in the investor community is that if there are no money-making apps in AI, eventually people will stop buying the chips, and as this little blurb here says from the market here, the bottom could fall out of the AI market. So that's a consideration or a concern for NVIDIA going forward, as well as other mega cap tech companies. And when you consider that NVIDIA is trading at 30 times revenue, which is pretty absurd, especially now if their growth is decelerating, even if they do hit their projections or even exceed their projections, 30 times earnings where it's currently starting as a valuation probably still doesn't make sense. So I think longer term, NVIDIA will likely go back into the below 50, and I think there's a gap at around 30. So I expect it to fill that gap at some point. Whether it has another leg higher before it starts moving down in a consistent way, that remains to be seen. But if we look at the Nasdaq is in an interesting technical situation. So this is the Fibonacci extension level. So if you take this all-time high and this low in October of 2022 and do this Fibonacci extension level voodoo, you come up with the fact that the Nasdaq 100 stopped going up at the 1.618 extension of this high to low range here from late 2021 to October 2022. Take that range, extend it, and it stopped right at the 1.618 extension of that. It sold off, and it bounced right at the trend line from the low in December of 2023. And then it bounced again, and it looks like it could be stopping here at the 1.5 extension of this range. So the technicals have been playing out almost precisely with the Nasdaq. If the AI companies, if their growth is decelerating, that is likely going to be a headwind for the Nasdaq going forward. If we look at some of its components, here's Meta. It's in this huge megaphone pattern dating back to 2018. It's hit the top of the megaphone 4 times in the last this year, since the beginning of 2024. Each time it's been rejected. So far it's been rejected the 4th time it's hit that. If it eventually does break higher out of this megaphone, then I would expect the Nasdaq and the S&P 500 would be in a blow-off top, and that's probably the last leg higher before valuations just start to weigh too heavily on the equity market and we head into an extended bear market. So this is something that I'm watching closely. Can Meta break out of this megaphone? If it does, again, blow off top. If it doesn't, this is also a rising wedge pattern, which is bearish. When it breaks down from that, that's probably a signal that we are into that extended bear market. Here's Apple. Same thing with Apple. It's in this bull flag pattern, which projects to 251.79. It's below its recent high. But if it does eventually make its way up to 251.79, without us having an extended bear market first and then it rebounding, many years later, if in the near term it does make it up to 251.79, then again I would expect the S&P and the Nasdaq to be in the final leg higher of this cyclical bull market before we eventually top and roll over. The S&P is also obeying these technicals as well. So it topped at the 1.618 of its own 1.618 extension of the high from January 2022 and the low of October 2022. It sold off as the yen carry trade unwound, and then it bounced in early August and it came right back up to its all-time high essentially, and again the 1.618 extension, and it seems like it's having some trouble at that level. So again, we're seeing some headwinds for equities. Now, one thing that I think will keep equities from having the rug pulled out from under them is that we have had a lot of government transfer payments this year. Every month of this year, the government transfer payments have been positive on a year-over-year basis. If you look in 23, there were many months where on a year-over-year basis, the transfer payments were negative in terms of their growth. But in this election year, they're not taking any chances. And we have positive year-over-year growth each month in government transfer payments. So that will likely keep the consumer from falling off a cliff, which will likely keep equities from falling off a cliff, at least now until the election. But September tends to have not so great seasonality, especially starting in the middle of September. So this is the average of the yearly performance of the S&P 500 over many years, decades, and from September to the end of September tends not to be so great for the S&P 500. And if we look at the VIX, from the middle of September until the end of October, the VIX tends to rise, so volatility tends to increase, which likely means more choppy trading ahead. And we are moving into the last 8-9 weeks until the election. So we would also probably assume or expect volatility to be elevated as we head into the election, as that uncertainty grows as to what the outcome will be. Now here's a sneak peek of this week's newsletter, Composite Equity Relative Sentiment, which a few weeks ago at the beginning of August, whenever the market was selling off and the yen carry trade was unwinding, got more bullish. It went from 73 to 76% as the market was selling off. Well, now as it's been rallying and gone back up to the highs, it's turned bearish. It's below 50%, which is bearish. Now, between 40 and 60, it tends to be sort of a neutral sideways type of performance for the market. So 42% isn't the end of the world. It's not forecasting, hugely negative annualized returns, but it is likely forecasting below average equity returns in the near term, which again adds to the evidence that, the technical evidence, the relative sentiment evidence, and I'll soon get to the fundamental evidence that equities could have some headwinds here. Now, what is that fundamental evidence? Well, once again, valuations are again knocking on the door of the worst levels of all time. Now, whenever this valuation ratio was 0.52, 0.527 at the top of the dot-com bubble, wasn't a great time to be buying equities. When it was 0.518 at the top of the everything bubble, wasn't a great time to buy equities. Equities sold off 25%. Here they sold off 50%. Now we're basically at those levels again. Could we have another leg higher before topping? Certainly. But is that if we do have another leg higher, will it sustain? Almost certainly not. Not with valuations at these levels and the risks of recession, the U.S. fiscal situation blowing up, geopolitical tensions blowing up. I can't see that any gains from here sustaining. So from a fundamental perspective, equities don't look attractive. The forward expected return on an annualized basis is only about 0.5%. Inflation is likely going to be above 3% over the longer term, possibly even 4% if things get really bad. From 1965 to 1982, inflation annualized at 7%. We certainly could see something like that if things get really bad. So you're going to have negative real returns with equities over the next decade almost certainly. And that's reflected in the expected equity risk premium, which is minus 3.5%. So the 10-year bond is likely to outperform equities by 350 basis points per annum over the next decade. And where the 10-year yield is priced, that could very well have negative real returns as well, and likely will. If we look at the Nasdaq to Russell 2000 ratio, it's basically right where it was for most of 2024 before it kind of got a little bit wild and crazy from May to July, and then July to the beginning of August. But it's right back sort of in the meat of the distribution. I don't have a strong conviction about which way it's going to move in the near term. I think over the longer term, given that tech is probably the most overvalued and has the most to lose if the AI situation doesn't pan out, as people have priced in for it to pan out, then I would expect this to drift towards the bottom of this channel. But in the near term, it's hard to say, as we're not at an extreme, so it could bounce either way from here. If we go to the dollar is trying to claw back some of its recent losses. The smart money is still bullish on the dollar. They're strongly bullish on the dollar, and that bullishness will last at least until mid-October. So the dollar still has some time to try to recoup some of its recent losses. The market here put out this chart the other day that shows that other than this period here in 2022, the dollar's essentially stayed within a range, and we're near the bottom of that range. So it's not, crazy to think that it might bounce here. Now, how far it bounces, not clear, but the fact that it is towards the bottom of this range, that it does tend to be mean reverting, that the smart money is bullish, that equities seem to be having some headwinds, and when equities don't do so well, the dollar tends to do well. The dollar actually might cause equities not to do well by it rising, but you never know what the causation, which way it goes. So a dollar bounce here seems like it could continue, and a dollar bounce could potentially be not so great for gold. So this is gold. It's in this, so composite relative sentiment for gold is bearish, and that's a combination of gold, silver, dollar, and euro relative sentiment. Gold relative sentiment itself is bearish, although smart money has been buying gold the last couple of weeks in a non-trivial way, somewhat aggressively. So we'll see if that continues when we get the data out later this afternoon. But even if gold relative sentiment itself were to turn bullish, the landscape still wouldn't be so great for gold, because dollar relative sentiment is bullish and euro relative sentiment is bearish, and it likes the opposite. It likes either dollar relative sentiment being bearish or euro relative sentiment being bullish. Now, dollar relative sentiment turning bearish, it's not going to happen in the near term. It can only happen sometime in October. And that's if the smart money started selling it hard today. With respect to euro relative sentiment, which is currently bearish, gold likes it to be bullish. It could turn bullish at any time, but it doesn't seem like it's in a huge hurry to do that. So what we would need is euro relative sentiment to turn bullish, and we would need gold relative sentiment to turn bullish, and then the landscape would be much more favorable for gold. But a lot has to happen before that actually transpires. And in the meantime, gold is in this rising wedge. The dollar's trying to claw back some of its gains. Gold has been rising almost certainly because the dollar has been having a hard time. So if the dollar starts to do well, you might see gold pause here. Rising wedges tend to be bearish. It's well above its 200-day moving average. So it wouldn't surprise me if gold and silver and miners, take a break, potentially pull back until the landscape becomes more favorable for them from a positioning perspective. If we look at long duration bonds, so They did very well as the market was selling off, as the yen carry trade was unwinding and volatility was spiking. They pulled back a little bit, but have rallied again and then have pulled back. Now, the current levels probably don't make sense over the longer term, given the U.S. fiscal situation, given the fact that if we do have a recession and deficits explode and treasury supply explodes and sovereign, countries aren't buying, central banks aren't buying our bonds, they're buying gold instead. So the buyers are essentially hedge funds, so we're a lot more price sensitive. It doesn't seem like rates can sustain these levels. Even if we do have a recession where the knee-jerk reaction is that, rates are going to go lower. Well, okay, they go lower, equities fall, unemployment rises, tax receipts fall, they don't stop the spending, deficits explode. Now you have all this treasury supply. That's going to put pressure on the rates to move higher unless the Fed pins them where they are, which would then cause inflation to become unhinged, and you wouldn't want to be holding those because you'd have negative real returns. So these don't seem like they're very attractive where they're currently priced. Inflation should cause pressure on them. A recession should cause upward pressure on them. So we're in a secular environment where long duration bonds are probably going to be one of the worst performing assets and generate negative real returns. Gold will probably be one of the best performing assets. And as you can see, even though the positioning environment has been unfavorable, it's still been doing well. It's been very resilient. I do expect it to potentially struggle in the near term if the dollar starts to claw back some of its recent losses, but nonetheless, gold is a much more attractive asset than long duration bonds in this secular environment. The core PCE came out today, and the super core, which is something that the Fed has noted that it looks at, is now up 3 months in a row, or at least 2 months in a row, and it's starting to curl upward again. So that's something to keep an eye on. Inflation isn't going away. The environment, the secular forces are there to conspire to keep inflation sticky for the remainder of this decade. So it's just a matter of keeping an eye on inflation to see when it does reemerge. We had a 7-year bond auction just to cap off the discussion of bonds. So a couple weeks ago we had a 10-year auction and a 30-year auction. Both of those were very bad auctions. And here we had a 7-year auction that also didn't go very well. So we could see bonds potentially struggle, move sideways, possibly drift lower, rates drift higher, and positioning in long duration bonds, the composite relative sentiment for long duration bonds is pretty strongly bearish at the moment as well. So to summarize, I think equities could potentially struggle here, face some headwinds. I don't think the rug's going to be pulled out from under them, but I don't expect them to start soaring again and have a blow off top just yet. The technicals, they're at some resistance levels. Relative sentiment isn't looking so great, and the fundamentals again aren't looking great as well. The dollar looks like it could be bouncing, and if the dollar bounces, gold probably pulls back, and rates probably go higher. So that's what it looks like at this point. We'll get some more positioning data today at 3:30 Eastern time. We'll see if that changes any of this. I don't suspect it will, but if it does, I'll let you know in the weekly newsletter. So thanks for watching.